Please welcome Philipp Hildebrand, Vice Chairman, BlackRock, and Bloomberg's Francine Lacqua.
So much. We have 20 minutes to redo the world and talk about recession risks and inflation risks on the banks.
It's wonderful to be here. Between an invitation from you and Ireland, I couldn't resist.
Irresistible, especially when you talk about all the hard stuff like inflation. What are we getting wrong on a possible recession? Is it going to be uglier than we think worldwide?
I think the key thing to understand is there's a set of trade-offs involved here. If we want to get inflation down, we're going to have to constrain the economy and probably get to some kind of a recession, hopefully a shallow one. The soft landing idea that's been so embedded in people's minds from the Great Moderation period, I don't see that happening. This inflation environment is new, with a completely new regime, macro volatility, higher inflation. To get inflation back down is going to entail some costs, and that means we're going to have to constrain the real sector and eventually have a recession in order to get inflation down.
Do you think central banks and the Fed actually want to get back to that 2% target? Because if they don't, maybe it's more manageable. If they get to 2%, will they willingly have to crush the economy?
I think that's the key question. There's no doubt that you have to really bring growth down in order to get inflation down. Whether they will push it all the way to 2%, we'll see. I think the key is to get it to a level where you no longer have to worry about long-term inflation expectations becoming unanchored. And what we can say today, we're not there yet. So although headline inflation has come down quite significantly, core inflation remains very tight. The labor market remains very tight for slightly different reasons in Europe and the US, but nonetheless. And so we are not at the point where you can say, okay, now I can pause and see because I don't want to crush the economy too much. That's a story for the next couple of months. We're not at that point yet. We still need to now get inflation further down in order to avoid any kind of long-term unanchoring of inflation expectations.
I mean, you had a pretty incredible career. So you've been a central banker for a long time at the Swiss National Bank. Now you work in markets. What are central banks getting wrong now, and what are markets getting wrong about central banks?
Well, I think the market, at least in the U.S., is frankly, I don't see any scenario where we have interest rate cuts this year unless you had such a disaster, some new exogenous shock that would be so dramatic that we would be in a deep recession. But at this point, the idea that you have rate cuts coming up seems to me wildly optimistic from the marketplace. I think the central banks, they know what they need to do. For them, what is different from the previous 2 generations or 3 generations of central bankers is that we have been so used to the fact that every time there's a problem, central banks come and ease. This has been the kind of playbook, throughout my career, before that, after I left. Now we're in a very different environment. Central banks actually have to create a recession, in essence, to get back to price stability. So it's a complete reversal of the modus operandi, in a sense, of central banks as they've known it for the last several decades. So that's why it's not so much that they're getting something wrong. They've now acknowledged that there is this trade-off, these costs to pay, but it's a completely different way of thinking about central banks, and it's a different role. Another way to put it is they have to be unpopular now in order to get inflation back down, where it used to be you could count on them each time to rescue you, to stabilize the system, to bring support. And that has shifted. And I think many people, even in the markets, have not quite understood, in my mind, how much we are now in a different regime compared to the last 4 decades, effectively.
So it's almost an easing bias in the markets? How would you describe it?
In the U.S., yes. And I think it's this idea, this almost pre-programmed idea, when there is a problem, i.e. potential recession, central banks will come and ease. Yeah. Well, that worked as long as you had no inflation, no protracted inflation problem. But we now live in a different world for various reasons. We can come back to that. Inflation is higher, more protracted, and therefore you need the central banks to do the opposite of what they've always done. So the kind of knee-jerk reaction that the world has learned in recent decades, problem, central banks ease, has now completely been turned on its head, where the central banks have to actually tighten or run tight monetary policy in order to get inflation back down.
Just a reminder to our lovely audience that you can also ask questions through the QR code, which I think you have either on the right or the left. You talk about exogenous shocks. Is that like another banking crisis to what we've seen in March?
Hopefully not. I think we had a mini banking crisis, which fortunately was contained. I don't think Europe has a structural banking sector problem per se. In the US, we know that you have too many small banks. There's a deposit story, but hopefully with the measures that have been taken, both in the US as well as in Europe, particularly in Switzerland, we can now say that we have stabilized, the authorities have stabilized these concerns around banks. And so hopefully we can avoid any kind of systematic banking crisis. Certainly in Europe, I don't really see, you can always get surprised that I've been in this business long enough to be humble, but I think at this point, I'm not particularly worried about a kind of systematic problem in the banking sector.
How will we look back on the month of March? So is it the fact that we can change and transfer money so quickly, is that going to be looked at by regulators, or is it a story about rising interest rates?
I think it's mostly a story, in a way, a fairly traditional story. When you raise rates so quickly, and when government bonds re-rate so dramatically and so quickly, you have to really pay attention as a risk manager, right? That's true whether you're a treasurer at a bank or any other risk manager. This changes kind of fundamentally the market outlook. It's certainly true that technology probably has accentuated some of these deposit outflow stories. I mean, we've lost, the banking sector globally has lost 800 billion, a bit more than that, of deposits in the last year, which is a remarkable number. I don't think anybody could have anticipated that a year ago. So there is something that went on. I don't like the story, it's because of cell phones. I think that's too simplistic. There were some serious mistakes made in terms of strategy, in terms of risk management. Do we live in a world where things move more quickly than in the past? Probably. Will we have to readjust some of these liquidity ratios and regulation? That's undoubtedly going to happen, to say that our assumptions on liquidity were probably too optimistic, and they came out of the 2008 crisis, and we'll have to revisit that, and I'm sure regulators will do that. So it will mean at the margin that banking becomes a bit more expensive, a bit more difficult, and probably a bit less profitable, which of course is the second force that now exerts pressure on the economy, in the sense that if we have, on the one hand, higher interest rates, and at the same time, tighter credit conditions, tighter financial conditions, the banking sector that provides less lending at the margin, that will be another force that leads into this contraction of the real sector that hopefully over time will get inflation down.
Do you think the business models of banks will change because they'll have to offer more to depositors to keep them with? Yeah,
it's a very good question. In the old days before 2019, if you had, for whatever reasons, deposit outflows from banks into money market funds, let's say, which is what's happened to a large extent in recent months. The money markets, people like us in the capital markets, would ultimately bring that money back into the banks. With the reverse repos that were introduced, it's a technical matter, but in my mind very important in 2019 to make monetary policy more efficient. That money does now not end up back in the banks, but ends up on the balance sheet of the central banks. And so when all that money came out of the deposits into money market funds, the asset management industry or the capital markets basically can now deposit that money at the Fed. So there is a kind of structural decline in deposits and in attractiveness of having assets in banks, which again at the margin tells me that banking is going to get more expensive. And therefore, probably, at least in the short term, we'll have a bit less funding that comes from the banking sector into the economy. And that, again, will work in a restrictive sense on the real economy.
When you look at the markets, and I don't know whether this is an exogenous shock, or when you raise interest rates from 1% to 4, 5, maybe 6%, what else do you think breaks?
Well, we have written about this extensively, and the way we try to paraphrase it is to say cracks will appear. It's very hard to predict exactly where they appear. I don't think many people would have said it's going to be one bank or two banks in California and then the big bank in Zurich. It's hard to predict where these cracks appear. What we do know, we have not seen an increase in rates at that pace and as aggressive as we've seen since the early 1980s. So this is a new phenomenon. And, cracks have appeared. The question now is, will more appear as the economy slows? What has not really happened yet, we are not yet in a recession, or at least not yet in a visible one that you see in the data. Profit margins or profitability, corporate profits, continue to be pretty robust. And at some point, as the rates feed through, as tighter credit conditions feed through, as the banking system retracting a bit feeds through, at some point that's going to weaken the real sector, and then you start to see more cracks. Where they will be is hard to tell. The two favorite ones that people mention are commercial real estate or the re-rating of private market assets as these prices adjust to where public market prices are. Those are two, candidates. There can be others. I think the key is we have to be cognizant that as this tremendous tightening feeds through the system, hopefully inflation will come down. We're seeing that at least as far as headline inflation goes, but we will also quite likely see other pressure points, other cracks that can appear in that kind of environment.
So you were instrumental in 08-09 in putting together the government response at the S&B, also to get UBS through turbulent time. What was March like, seeing Credit Suisse just disappear?
Well, it brought back a lot of bad memories. Personally, obviously, although it's quite a different story. Back in 2008, it was really kind of a surgical strike. There was a cancer in the balance sheet, which was well defined. Turned out to be 40 billion of bad assets, and we came in with the help of the government as a central bank and basically took it out. So it was a kind of, think of a cancer surgery. You go in, it works, successful, and it's over. This was much more complicated in that it was a kind of a slow burning, I would say, probably the best way to describe it would be a loss of confidence in the business model and probably also in management. So it's a very different set of circumstances that led to a similar kind of weekend. From what I know, and obviously only from outside, in 2008 we had the benefit of having been added in terms of preparatory work much longer. This was a really hard one to tackle because it came quickly at the end. It accelerated very, very quickly within 1 week. There was enormous pressure given where the global system was to come to a solution essentially over the weekend. So I think given all that and given where the authorities were at that point, it seems to me that the government in particular has done a very good job, not just for Switzerland itself, but also for the global financial system. And particularly, I think, a full resolution, at that point, given where the system was at that point, would have been extremely delicate. So I think the government handled this as well as you could have. The question now will be, how does this settle? And how does UBS position itself going forward, given quite intense political discussions in Switzerland around competition, around size, and many other issues. So, this story is not over, but the emphasis has now shifted to what UBS is going to do with it, as opposed to what the government did. And I think the government handled it under very difficult circumstances very well.
How will UBS do it?
I don't know. I think, as always in life, particularly when you face complex things, it's all about execution. You can talk about difficulties all day long, but in the end you have to execute. This will be a big execution story. I think it's a culture story. The chairman of UBS rightly, in my mind, has indicated that these were two very different cultures, which makes any merger is difficult or any acquisition is difficult. When you have two different cultures, it makes it more difficult. So it's mostly going to be about execution, and then I would say wisdom in terms of how they handle which is admittedly a national discussion. It's not really an international problem, but a very intense national, very emotional national discussion around this very large bank, this single very large bank that's now in the country, in a country that has always historically had several large banks. That's a big change for the population, for politics, and we'll see how UBS handles this. I think it's early days. There are various options, and we'll see how they steer this. I think the chairman of UBS is extremely experienced, and we'll have acquired a taste of the national context, and I'm sure we'll steer the strategy, in a sense, in an appropriate direction.
I mean, I ask you this every 2 years. Are we going to see more consolidation in Europe? I don't know whether this was, something that spurs it.
Well, we've just seen a big one, or at least it's in the making. This is if you take the aggregate banking landscape in Europe, this is a pretty meaningful consolidation. My guess is the consolidation story right now, the focus will be more on the U.S., on what will be the results, the consequences of changes in regulation, going back on some of the deregulation that was introduced in 2018, and how will that impact the landscape of thousands of small banks in the U.S. To what extent will we see consolidation there in light of what happened in the U.S.?
I have two great questions from the audience. One actually asking how well are the priorities of the financial sector aligned with meeting Paris climate targets?
Well, I think the key issue on this is government policy. Right? I've always said what the financial sector can do, whether it's the banking sector or the asset management sector in different ways. In asset management, it's not our money, it's our clients' money. So we have a fiduciary role that's a little different than running a balance sheet in terms of credit decisions if you're a bank. But in both cases, the financial sector will respond to what the politicians do on climate. And what I've always said, finance can and should be an accelerant in a sense, or an amplifier by way of reallocating capital towards technology and new enterprises that will make up a decarbonized economy. But the direction has to be set by policy. And I think the COP will be a very important moment in Abu Dhabi to determine where do we have levers that policymakers can use in order to kind of set a clear strategy on how they intend to get there. And the clearer that strategy is, the clearer the decisions are that politicians make, the more finance can play the role that it can play to be an amplifier by reallocating capital. What has really bothered me in recent months, really, or even longer than that, is this kind of notion that politicians, in a sense, can step back from the challenge and just say, finance, you fix it. I think that's the world upside down. Finance or the economy as a whole basically follows the direction set by public policy. So I think it's really important, and one key issue here, which perhaps is somewhat symbolic, but I think actually very important, particularly for the developing world, where the biggest climate challenge changes exist, is can we reform the World Bank charter? Can the rich countries get themselves together to think about how to allocate their capital into the World Bank in a different way so that we can use the World Bank and the MDBs more broadly as a way to incentivize more private capital to be mobilized for the vast sums of investments that will be needed, particularly in the developing world, in order to give them a chance to both develop and at the same time reach the climate goals. I think if the rich countries fail in doing that, and I do believe this World Bank reform in a sense can come to a head or should come to a head around the time of the COP, I think you will just see more and more of the kind of global south type of dialogue that says, well, who are you to tell us what to do? Where are you when we need your help? Where were you during COVID? Where were you during other episodes in recent years? This, to me, is one of the worrying things that we are seeing a lot of division, fragmentation. It was just mentioned in the earlier session, between, in a sense, what's now often referred to as the global south and the rest of the world. And climate, in a sense, and the COP is an opportunity for the rich countries to kind of step back into this game with clear commitments, and then you can have financial markets, amplify the trend. I mean,
there's things that financial markets can price badly or wrongly, but are pricing, and there are things that they're ignoring. I don't know where the debt default in the U.S. Where will it happen, and what happens to markets?
Well, it must not happen, to be honest. There are very few countries that have never put in doubt the sanctity of their sovereign signature. If you actually look at the history of finance and countries, very, very few sovereigns have never defaulted. Two of them are Switzerland and the US. You don't want to change that. The fact that the US has never defaulted on its debt is a basic anchor of financial markets as they exist today. There was a time under Hamilton, the historians here will know that, there was what's called an assumption, but a formal default has never occurred in the history of the United States. And very few countries, to my knowledge too, there may be one or two others, but have never defaulted on their debt. This is a critical anchor of the financial system. You don't want to mess with that. And all we can do, I think, collectively, all of us, is to pray that everyone in the United States understands how important the sanctity of the sovereign signature of the leading currency, of the leading bond market, of the leading economy in the world is. And this is not something you want to mess with. So I think that the short answer is it must not happen.